U.S. President Donald Trump says a 50% copper tariff is coming August 1st, and Canadian copper.
We're going to be putting a very large tariff on chips and semiconductors.
President Donald Trump announced a new tariff. This time, the target is copper. All imports will be charged a 50% duty starting August 1st.
Canadians are reasonable, and we are polite, but we will not back down from a fight.
President Donald Trump's announcement of a sweeping 50% tariff on copper imports has triggered an unprecedented crisis that is reshaping America's industrial landscape and threatening to cost the economy billions of dollars. The tariff, which took effect on August 1st under Section 232 of the Trade Expansion Act, was designed to protect national security interests, but has instead created a dangerous economic standoff with devastating consequences for American consumers and businesses. The immediate market reaction was nothing short of catastrophic. Copper prices on the Chicago Mercantile Exchange exploded by 13% in a single trading day, reaching nearly $6 per pound and shattering all previous records. Meanwhile, the London Metal Exchange told a completely different story, with prices actually declining as global markets feared American demand would collapse under the weight of these punitive tariffs. This created an unprecedented price gap of 25% between American and international copper markets, exposing fundamental flaws in the protectionist strategy. Canada, which supplies more than half of America's refined copper imports, responded with swift and calculated retaliation that has caught Washington completely off guard. Within days of the tariff announcement, Ottawa froze existing contracts and began systematically redirecting its copper exports away from American buyers toward Asian and European markets. Major mining operations in Quebec and British Columbia, including industry giants Glencore and Hudbay Minerals, immediately began rerouting shipments to buyers in Japan, South Korea, and China, rather than continuing their traditional flow to American refineries. The Canadian government has made its position crystal clear through actions rather than words. A massive $1.8 billion investment package was unveiled to strengthen export capacity beyond North America, including new shipping infrastructure and expanded facilities specifically designed to serve Asian markets. This represents far more than a temporary adjustment to trade policies. Canada is fundamentally transforming itself from a supplier dependent on American demand into a strategic competitor that will reshape the global copper trade for years to come. The consequences for American industry are already proving severe and widespread. The United States produces only slightly more than half of its refined copper needs, importing over 800,000 tons annually from Canada, Chile, Peru, and Mexico. By imposing these tariffs without securing reliable domestic alternatives, Washington has created shortages that no quick policy fix can resolve. American refining capacity remains woefully inadequate, with major facilities in Arizona and across the Southwest lacking the scale to cover the massive gap left by lost imports. Manufacturing sectors across the country are absorbing devastating cost increases that are being passed directly to consumers. Electric vehicle production has been particularly hard hit, with each new car requiring nearly 80 kilograms of copper in wiring, batteries, and motors. Industry analysts calculate that tariff-driven price increases have added approximately $90 to the cost of producing every electric vehicle, translating into millions of dollars in losses for companies already operating on thin profit margins. Tesla, Ford, and General Motors are watching production costs climb month after month as key projects face delays or outright cancellation. Several major electric vehicle programs in Michigan, Ohio, and Indiana have been forced into suspension not because of insufficient demand, but because the essential materials needed for production have become prohibitively expensive. General Motors alone acknowledged $1.1 billion in losses from previous trade conflicts before the copper crisis even began, and company executives are now bracing for even deeper financial wounds. Smaller manufacturers specializing in electrical wiring and consumer electronics are facing an even sharper competitive disadvantage. Throughout the Midwest, the price of imported copper wire has jumped 18%, making it impossible for American firms to compete with suppliers in Southeast Asia, where copper prices remain stable. Contracts that were once guaranteed to flow to American factories are now shifting to companies in Vietnam and Thailand, leaving domestic workers and business owners struggling to survive. The crisis is spreading rapidly through America's critical infrastructure systems. Utility companies responsible for maintaining and expanding the nation's power grid are struggling to contain spiraling costs as copper-based conductors and transformer cores have seen price spikes exceeding 20%. These increases cannot be absorbed by utility companies indefinitely, and emergency requests for electricity rate hikes are already being filed across multiple states. Those cost increases will inevitably appear in monthly bills sent to households already grappling with persistent inflation. Construction firms are battling significantly higher costs for copper-based insulation and wiring, pushing project expenses upward at every stage from residential homes to large-scale commercial developments. A recent analysis shows that home construction projects are becoming more expensive by $17,000 to $22,000 per build due to copper-related cost increases alone. Energy companies are raising urgent alarms about delays in renewable energy installations, since copper remains critical for wind turbines, solar arrays, and transmission systems that form the backbone of America's clean energy transition. Telecommunications giants are preparing for supply bottlenecks in equipment needed to expand broadband and 5G networks, potentially slowing the technological infrastructure improvements that are essential for maintaining America's competitive edge in the global economy. Every sector that relies on copper is now absorbing the shock of policy choices that failed to account for the complex interdependencies of modern supply chains. A comprehensive analysis by UBS projects that American GDP could shrink by 0.5 percentage point this quarter alone, as major industrial sectors stall under the weight of these disruptions. The economic losses from tariff fallout already amount to more than $4.2 billion. Matching almost exactly the volume of copper trade that was frozen when Canada severed its supply chain connections with American buyers. This correlation provides stark evidence of how deeply dependent the American economy has become on copper imports, and how dangerous it can be to disrupt networks that support entire industries. The burden on American households is becoming impossible to ignore. Higher electricity bills, costlier home repairs, and more expensive consumer goods are direct results of copper-driven inflation that traces back to a single policy decision in Washington. The copper inside every light fixture, every wall wire, and every electric vehicle charging port is steadily raising costs for consumers across every income bracket and geographic region. Canada's strategic response demonstrates that even smaller economies can push back effectively against economic pressure when they control critical resources. By mobilizing billions in investment and forging new international markets, Ottawa has transformed what appeared to be a position of vulnerability into a powerful tool of economic leverage. Copper exports worth over $9 billion annually have shifted from being a symbol of dependence to becoming a weapon that challenges American economic dominance. The long-term implications extend far beyond immediate financial losses. If Canada's export redirection strategy succeeds, the United States could permanently lose its privileged position in global copper markets. Asia would emerge as the new center of copper refining and trade, leaving Washington dependent on global prices it cannot control and supply chains it cannot influence. This scenario would fundamentally reshape not only the copper industry, but the entire balance of industrial power between nations. What began as a policy designed to achieve American independence has instead exposed the weakness of domestic infrastructure and the harsh reality that complex supply chains cannot be rebuilt overnight. Rather than creating self-reliance, these tariffs have pushed the United States to the margins of supply networks that are increasingly centered elsewhere, potentially costing the American economy its industrial leadership position in critical sectors that define modern economic power and national security.